Hi everyone, welcome back to Atrium Research's YouTube channel. Today I have the pleasure of interviewing Aziz and Sajid, the CEO and CFO of Sabio Holdings, which trades on the TSXV under the symbol SBIO. We recently initiated coverage on Sabio, citing its position in the ad-supported TV market, providing major growth tailwinds over the coming years. Sabio has posted solid margin expansion over the last few years, with EBITDA margins rising from 2% all the way to 8%. And the stock still only trades at roughly 7 times 2025 expected EBITDA, which is the largest discount to its peers. We have a 90-cent Canadian target on the company based on 9 times EBITDA. Aziz, Sajid, thank you for being here today.
Thank you for having us, Nicholas. Appreciate it.
So to start it off, the guys are going to walk us through the company presentation here to give us a flavor of what the company does and their outlook, and then we'll move on to some Q&A.
Great. Thank you. We're a company in the ad-supported streaming space. We're a profitable ad tech company with the potential of recognizing revenue in a $45.8 billion market opportunity. We have hit a rule of 40 based off the 2024 growth, which means both EBITDA as well as overall top-line growth, and that's really the combination of that got us to a rule of 40. And we have a recurring business model, 85%, and actually that is closer to 90% if you exclude some of the new international brands that we've had added to our list. And then finally, what differentiates us is our proprietary technology, which I'll get into a little bit. We have a key leadership team, myself, Sabio Holdings, our CFO, and Jason Tong. And before I get into future slides, I'll just give a little quick history of myself. I started my career at Fox, spent 2.5, 3 years there, went over to NBC for 6.5 years, AT&T for 3 years, right when they got the iPhone, helped them build out their business, their advertising business, and then went over to Opera, the browser company. And in all those journeys, what I recognized was the fact that there wasn't enough data-driven marketing involved. And where I believed I really wanted to focus in on is to focus in on in-app space, whether it's an app on mobile devices or app on TV, it's an app. And so that's really what our differentiation is, and I'll get a little bit more into that in a few slides. Next slide. And as mentioned, there's a $45.8 billion market opportunity. So it's big, not only for streaming TV, but the diverse market. Give you some context. The U.S. market, when I started the company 10 years ago, was only roughly about 15 to 20% diverse. Today, Gen Z, which is the 12 to 24-year-olds, account for 48 to 49% being diverse. So that's a huge market, a huge opportunity, and we're positioned not only in the streaming space, ad-supported streaming space with cord cutting, but we're also positioned well in the diverse space. Next slide. And really what differentiates us is this proprietary graph. And when I talk about a graph, think of it as data points in your home. And so today in the US, we have multiple data points that help us better understand the consumer. In our case, what we're really lean heavily on is mobile IDs, mobile devices. We combine that mobile device data, which is app data, location visitation data, in a privacy-compliant way with TV household data. So that is where the TV is on the wall. So streaming, people who are watching ad-supported streaming shows or that type of programming, we're connecting the dots between mobile devices in that home and the streaming viewership that they're watching. That allows us to have a very rich 80 million household graph across the U.S., which accounts for 70% of the U.S. population, so U.S. household. And so, we really are in a very unique position from a data-driven perspective. And we also have, the brands we've worked with recognize that. We've helped them understand all audiences as well as understanding diverse audiences. And that's why we've been working with some major brands. And in fact, if you Google, McDonald's and Sabio, you'll see a joint press release with us and them. And it speaks volumes to the fact that a small company our size is working with some of the biggest brands in the world, not only just here in the U.S., but globally. And really the business model is, and this speaks to the case studies on both McDonald's and Toyota, but really the business model is driven by our data insights. What we do essentially is we serve out targeted ads, what we call REV, reach, engage, and validate. We help brands reach consumers on streaming devices, and think of it as apps on Samsung TV, apps on Amazon, ad-supported apps on Amazon streaming apps, apps on, ads on Fubo and different apps like that, as well as helping them understand those consumers more effectively. I'm going to hand it over to Sajid Premji, our CFO, to talk about our business execution.
Yeah, thank you, Aziz. And on the backs of this business, we have experienced a significant amount of growth in a short amount of time. We went public in November of 2021 and raised what was relatively a small amount of capital, $8 million US at the $70 million US the valuation, and we used that to really propel our business. We've experienced 39.5% compound annual growth rate from 2020 to 2024, and you add to that, which has EBITDA margin of 7 to 8%, and that takes you well above the rule of 40 that the VCs love to cite. If you kind of go to the next slide, we've done this on the backs of two ways. Number one, we had that branded business, the Toyotas, McDonald's, etc., that has led us to a compound annual growth rate in political years of 37%. And if you can imagine how important that data is for a brand like McDonald's or Toyota, it's just as important, if not more so, for a political campaign and who wants to reach out to a certain demographic to bring out their vote. And so if you look at our political years, we've experienced a 66% compound annual growth rate through the end of 2024, this most recent election cycle. And that really showed itself in our full year in Q4 annual results. If you look at Q4, we saw 42% growth year over year from 12.7 million US to a rate between 18 and $18.2 million based on our preliminary results. How that translates annually is you see basically a rate between 49.3 million US and 49.5 million US for the year versus 35.9 million US in 2023. So that's a 37% growth rate. And you kind of convert that to Canadian dollars using the average exchange rate for 2024, and you're close to a $70 million Canadian company. We've been able to do that while maintaining 60% gross margins and having a 90% recurring revenue rate through the end of Q3, 86% for the full year. And as Aziz touched upon, if you were to exclude some of those new brands in the international business, that number is closer to 90%. And as well as we are doing on the top line, what gets us even more excited is our traction on the bottom line. In our business, advertising is seasonal. You have a lot of your big events in the last half of the year, your back to school, Christmas, Halloween, etc. We typically generate between 65 and 70% of our sales in the back half of the year. So typically with that kind of model, we lose a bit of money in the first half of the year and then more to make up for it in the second half. And what we're seeing is that with a much leaner cost infrastructure, we've seen those losses in the first half become a lot more shallow and those gains in the second half becoming a lot more pronounced. If you look at the first half of the year, we lost about $1.7 million. And you compare that to the first half of 2023, we lost about $3.9 million. So we shaved off quite a bit, $2.2 million off our first half loss. And then going over to the second point about our second half gains being more pronounced, we saw that in the second half of 2024. We had an EBITDA gain of $2.6 million in Q3. We've disclosed a range of between 2.6 and 2.8 million of adjusted EBITDA for Q4. All that adds up to a full year EBITDA range of between 3.6 million and 3.8 million US, close to $5 million Canadian based on average exchange rates. When you compare it to last year, we've seen between a 5.4 and $5.6 million improvement in adjusted EBITDA on a year-over-year comparison basis. And that all leads us up to today and what we feel is...
On that last slide, on that last slide, Sajid, just to provide some additional clarity, for those of you who are not familiar with the advertising space, the reason spending increases in third and fourth quarter is in third quarter you usually have additional expenditure in back to school and some of the events that are happening there. And then fourth quarter is obviously heavy retail because of Christmas. And so what tends to happen in advertising in general is you'll have lighter quarters being Q1, gets a little steadier, increase spending in Q2, and then Q3, Q4 is really where a lot of spending happens. So there's some context there as well. We get asked that question a lot.
Correct. Yeah, that's well said. And all that kind of, translated to a 7 to 8% EBITDA margin for the full year. And looking at where we are right now, from a market capitalization perspective, we still believe that we are very undervalued, especially compared to our peers. We have an enterprise value right now of close to $28 million US. This is a company, again, that's doing close to 70 million Canadian with sales, 50 million US. And we're also profitable, close to 5 million Canadian of EBITDA, 3.8 million US, at the top half that range. And we have a very clean cap table. If you look at our fully diluted share count, 55 million, that's relatively unchanged at the end of 2022, where we had a cap table of $54.2 million fully diluted outstanding. So not a lot of shares being issued, and we really have found this growth organically through reinvesting in our business, through our cash flow generation. And the market is starting to recognize that. We've seen a stock price that's up 204% from our 12-month lows in 2024. So, if an investor is worried about catching a falling knife, that we are well above those lows and on the way up. And we also have a strong insider ownership. 55% of our company is owned by insiders, and that's high alignment between shareholder interest and that of our own. No one here on the management team is going to get rich based off our salaries. It's going to be based on this share price moving up. And going over to the next slide and going back to my point about us being undervalued, even despite this movement up in 2024 on our share price, if you look at on our EV to revenue basis, we're still well above 1x sales, at 0.6x, well above all of our peers on this table. And that includes Acuity Ads in Canada, if you look at, which is now Atrium Holdings. If you look at on an EV to EBITDA basis, we're still also undervalued compared to our peers. 10x based on 2024's actuals based on 20 results, and 8x based on 2025 estimates as well. So both on a revenue basis and based on an EBITDA basis, we are well below the trading valuations of our peers.
And before we get to this point, Sajid, if it's okay, we can go back a couple of slides and talk about one of the things that we hear a lot from investors specifically. Go back to the slide where we show the revenue for last year in Q3, Q4. One of the things we hear from potential investors is like, okay, great, Aziz, you guys had a great year, and political was strong for us because we do play in the political space, as Sajid referenced. In context, the political did not account, as this slide talks about, it did not account for a lot of our really momentum. It only accounted for roughly $2.4 million of revenue in Q4. So that's not significant relative to our core business. And so as investors think about, okay, well, the stocks had made this great run, should I get in? The reality is, if you look at our business model, our core business continues to execute. And that has what we proved in Q3. We did that again in Q4. Sure, political adds to that, but it's not significant enough to where that is really a concern. In fact, what we have said publicly is the fact that in Q1 we will show double-digit growth on our core business, and we are we're holding to that. And so we're seeing a lot of, once again, strong momentum. And as investors think about this, as we get past Q1, which is our lightest quarter, we tend to then start accelerating the business. And then next year is a midterm election cycle. So, Q1 is the weakest quarter. We do great there. We're now off to Q2 and Q3. And the entry point will become less and less, and the reality is we're going to really kind of start accelerating for next year's political cycle. And it's going to be a big one, as you can imagine. The midterm election cycles are going to be huge in the United States. Not only that, we have the LA mayor's race and governor's race. And for those of you who are not aware, we're LA based. And so these are the last time LA mayor's race happened, there was $150 million spent on candidate money. So, we're positioned well in those categories, but we're also positioned well on our core business, and that really is the fundamental growth, core driver of what we're seeing.
Yeah, but that's well said. I think that is Susie's point. Our core business grew 20% in Q2, 28% in Q3, and if you see on this chart here, excluding political sales, 2.4 million, we still had double-digit growth in our business. So our core business is firing on all cylinders.
And we are going to continue seeing, balance sheet improvement in our overall company. That has been an objective of ours since the end of 23, and we've done that in 24, and that is going to continue on. We also most recently launched, and I know we'll get into this in a bit, but we launched a new channel called Creator TV, and that is going to be a great driver for our overall revenue and business model. And then we also have an amazing, board, a very established board. Paula Madison was a GE officer, and former at NBC Universal. Carl Farrell was a former CRO of the SAS Institute. Moise Keraj, Managing Director, Technology Digital of Cascade Capital. Gonzalo Delphi, he is the president of Group M Multicultural, which is the largest media holding group in the world. And then finally, Matt Hull has recently just joined us. He is the Chief Data Analytics Officer at Chamberlain Group, which is a $5 billion Blackstone-owned backed company. And so, we really have an amazing board for a company our size, and it's really the opportunity that we are presenting to the marketplace. And then finally, the key elements of why investors should really think about being part of the story is the fact that we have a unique value proposition and strong moat. We have a defensible moat with unique proprietary data, analytics, and insights. And our business model proves that with close to a 90% renewal rate. We're a high growth and profitable business. We're not one that is actually burning cash. We are both EBITDA and cash flow positive. And then finally, the landscape opportunities we discussed earlier is a $48 billion opportunity. And we are doing an incredible job of taking market share from some very big players. So we're positioned well and we're executing well. And that's it. Thank you for the time.
Amazing. That was perfect. And yeah, to reiterate, the main thing that I really like with you guys is you've done it all without diluting shareholders. So to post 39% annual CAGR on the revenue without diluting shareholders majorly over the last couple of years, that's not something that every microcap in Canada can say that they've done. So kudos to you guys, and I think it can continue. So let's move on to a couple questions that we've been getting from some of investors. So could you tell us a bit more about the competitive landscape and kind of what differentiates Sabio from some of the other people in the space?
Yeah, it's a competitive landscape where you have players like Magnite, Trade Desk, you have folks like Buy-In, you have QD Ads, less so because they're not in the streaming space, and you have Roku. And what really differentiates us, as we talked about, is the data analytics piece. This is something that is unique to us. We've been building it since 2016, where we are essentially bringing a lot of mobile insights and data into the streaming space, whereas everyone else just simply uses contextual data or third-party data sets that are not validated. We've been growing these data sets. We have been really focusing on that, and where we see the real opportunity, and we're seeing this, 50% of our revenue is on general market, but the other 50% is on diverse market reach. And so for brands, that's critical. As I mentioned, Gen Z is 12 to 24 is 48, 49% diverse. So if you are a McDonald's or you are a Ford or you're a GM, you want to reach those audiences. McDonald's doesn't want to reach people like me. I don't eat enough Big Macs. But the 12 to 24-year-olds eat a lot of Big Macs. And so, that's the opportunity that's why people are gravitating to us and working with us. And we've had the longevity of working with a company like Wells Fargo since 2015, GM and Ford and a lot of other companies. So that is really what really drives our business model overall.
Absolutely. No, that's great. And then I know you guys were guiding for double-digit growth in Q1. Do you think you can maintain that for the full year of 2025, or where should we expect the growth?
Sajid, do you want to cover that?
Yeah. So I think that, we were definitely seeing top line double-digit growth in Q1, and I think that's the goal for the year, is to have our core business continue to grow by double digits. We've seen that core business really propel itself in Q2 and Q3 and Q4 as well, and we don't see any reason why it should not continue to grow in the year to come. And that's on the back of, not only CTV, OTT business, connected TV, OTT streaming business that's growing by double digits and outpacing the industry at large, but also we have a new international business that has gained significant traction in 2024. We see a roadmap towards doubling, if not tripling those sales in 2025. We have a new programmatic CTV OTT offering that was launched in Q4. That's will gain more traction in 2025, and also a new performance marketing offering that was launched in Q4 as well. So, on the backs of a growing existing business plus new products, we believe that we're very well positioned to continue our growth trajectory.
Great. And yeah, let's drill into some of those growth engines there. So on the international expansion, where have you guys seen the low-hanging fruit, and in what regions are you kind of breaking into?
We're seeing a lot of great momentum in Europe in general. So, we're getting kind of ahead of our competitors there. We're seeing momentum across Europe as well as in the Middle East, and there's a huge opportunity there. At some point, we will, with the launch of our Creator TV channel, we're also using that as leverage to get into international markets, because now we have exclusive content running on a few channels, in terms of global channels, and that allows us to have that access to the global markets. So it's really been beneficial overall.
Right. And then on the Creator TV, what's been the strategy behind launching that, and how has it been going so far?
The strategy is twofold. First of which is to connect with different platforms that have streaming channels that will essentially create the content. And I'm just pulling up the most recent data we have. And so, we have two platforms that are already, we announced, which is Plex and Sling. Sorry, I was drawing a blank on Plex. Plex and Sling, and Plex is a global platform across the world. And we're going to have some additional announcements there. And the strategy there, quite honestly, is we're not in the production business. And so just to be very clear, I've actually had a production company many years ago, and it's a tough business. That's not where we want to play. What we're simply doing is we are working with the people who know how to create content, which are these influencers. And we're bringing them into the streaming space. So we're not creating content. We are just working with them to help them, provide them a diversification of their business model. Today, their business model is highly dependent on YouTube. It's highly dependent on Instagram and social. And so we're providing them another platform opportunity, and they're doing all the production work. We're fine-tuning it based off of our own needs from a CTV streaming perspective, and we're working with them on some original content, but we're not in the production game. And so that's really, if you think about our business model, Nicholas, we have 60% gross margins, and the other 40% is really goes to, for us to, for example, if we are running a spot on Samsung TV, we grab that spot in real time. We place one of our advertisers there, and we pay Samsung for that spot. That's all done in real time and electronically. Now this provides us an instance where now we can actually fill our own spots and make more of that margin. So it's really consistent with our business model from a perspective of margin increase. Now, the long-term objective here is to continue to have exclusive inventory and opportunities for our brands. Also, when you have the type of infrastructure we have, both from the ability to serve out the ads and then obviously the data infrastructure, we're building our own ecosystem. That's what's the great part here, is we're not dependent on someone else to serve the ads. We're not dependent on someone else to provide us insights and analytics. We're doing it ourselves. So we're literally building a new ecosystem for these creators, these content creators, who are the biggest stars in today's media world. Hollywood's dead. Let's face it. That whole business model is skewing very old to dead. It is. What we're focusing on is 12 to 24-year-olds who are watching YouTube and these social influencers. And that really is where we are seeing a lot of great traction. So we're seeing a lot of positive momentum, and we're very excited, and we expect to announce even more distribution deals in the coming weeks and months overall.
Great, understood. No, that's very interesting, and appreciate your guys' answers to those questions. So that's kind of all for me. Thank you for walking us through the story and the outlook for the company. And Sabio is certainly set up for another strong year ahead in 2025 as well as beyond that. So for all of our followers that haven't seen our research on the company yet, you can find it all on our website at atriumresearch.ca, as well as on X, on LinkedIn, and various other social media websites. And again, gentlemen, thank you for your time.
Thank you, and by the way, thank you for Atrium for the in-depth research and the probing questions. It wasn't easy, but we appreciate the the level of detail you provide in your reports, and we know certainly talking to investors, they appreciate it as well. So
Yeah.
thank you for
Perfect.
that.
Thank you.
Thank you.